Hey everyone, welcome to Long and Short. I'm Tom Hartman, Marketing Manager at TradersPost, joined by Mike Christensen, co-founder and CSO. In this series, we'll be walking Peter Hartman, another member of our marketing team, and my twin brother, through the process of setting up an automated trading strategy from scratch. This isn't a polished course, it's a genuine behind-the-scenes journey as we explore exactly what it takes to get someone with minimal trading experience up and running confidently. Let's dive in. Peter, you've had some time to refresh. Last time we went through basically a nice little mini intensive crash course thingy here about the strategy performances. But whether you had win rates, a higher or lower win rate, or max drawdowns, or value for average trades or net profits, I'm sure that means nothing to you because you haven't actually started sending signals and trading on a strategy just yet. So I want to show you here what the basically the whole process looks like, right? We've been focusing on TradingView, and we have to show you what it's going to be like later on when you're going to be sending a signal from TradingView through TradersPost and then to a broker in order to complete the trade. So you are mildly familiar with TradersPost at this point, right? You have some idea of the platform if you've visited it, but still, I'm sure you'll have some questions. So before we start that, I just want to show you, we're not going to go through like in-depth thing about how you can find like really good strategies to follow. We already talked about that in a previous video. That's really on you to go find, develop your own, find trading groups, YouTube videos, or whatever that might give you the type of strategy that you're interested in. There are as many types of strategies as there are people, right? The asset class you're trading, the amount you want to risk, your time frame, your horizon for trading, all that could come into play. So you can understand that that's really in your purview in order to figure that out. But we do need a strategy on our TradingView charts that'll generate buy and sell signals that can then be sent for automation. Mike set up a strategy here in the back end of TradersPost, in the documentation of TradersPost, where we can actually go ahead and grab one of these strategies. So in our documentation, if we head down to example strategies, you have a list here. Just to reiterate, none of these strategies are here because they're high performant or anything like that. There's just examples for you to use in order to use as a base for your own understanding. So there's a strategy here. It's simple strategy here, right, Mike? This
Yep,
first one
that's
at
the
the
one.
top? Perfect. So I'm going to click on that, and let me actually log into my account in order to get this. Then I can click on Add to Favorites. And now that I clicked on Add to Favorites, when I go back to TradingView, in my indicators under Favorites, I'll see the simple strategy. Just refresh. Simple strategy. Here, so I'm going to click on it, add it to my chart, and there we go. Let's remove the volume so not too confusing for your peer. All right, so this is just a simple strategy that does a bunch of buy and sell signals, right? So we have our strategy performance down here. It's appropriately bad, and as it should be. It's not trying to be profitable,
Right.
and it's generating these buy and sell signals that we're going to tie alerts to in order to send that over to TradersPost. So let's just set up a quick and dirty version, and then we'll talk about the different types of settings and order types that you can have associated with your orders. But to begin with, if I head over to my backend for TradersPost, I need to go ahead and set up a strategy here. The reason I'm doing this is that I need a place within the backend of my TradersPost to actually receive the signal, right? It needs to receive the signal, then process it in order to move on. So if I go to strategies, I'm going to go ahead and create a new one by clicking on new strategies at the top right. Let's call this one Peter's Winning Trades. We'll leave that on stocks for the asset class, and we'll just save that as is. We won't restrict it for what tickers can be traded. We'll let anything allow it all, and we won't have any other restrictions.
I do want to point out that calling the strategy winning strategy, unfortunately, does not improve the performance at all. I wish it did. I wish it were that easy.
Makes me feel better, I think, a
Yeah.
little bit.
No, I get it.
So I'm going to choose paper broker here for the broker. Always keep in mind, we always recommend that you always trade, Peter, with a paper broker. Okay? I hate it because I want to see real money doing real things. But I'm fine with losing everything that I put into the market, which I'm sure most people are not. So always make sure that you're using a paper broker first. And it's just great to make sure that the whole process, you're clear, you understand what signals are being sent through, you get that all set up. So once I save that strategy, I'm now moved on to the subscription setting. So as soon as I save my strategy, it says, hey, now you want to subscribe a broker to the strategy. That's why we call them subscriptions. You're subscribing a broker to that strategy. My broker here is the TradersPost paper broker. And now I'm just going to set up the name of my strategy. I'm going to do auto submit. So here I want trades to automatically not be pending and send me an email for me to approve. I want them to automatically go through. For sides, I'm going to switch this to both bullish and bearish because I want to be able to take long and short positions. And let's leave it at that for the moment. So I'm going to click on save, then enable. And now my subscription is enabled successfully. And I'm going to stay on this page because later on we're going to need it when we're grabbing our webhook URL, which is the link to which the signals will be sent. So actually, let's go ahead and click on View Webhook. Now, you'll see on the right side over here, we already get you jump started with this idea here of this is a JSON message payload. Essentially, it's a command that you're sending over to TradersPost to execute the trade. You'll see something similar like on any type of a third-party site like this that's routing trades. And we use the JSON format because it's a very recognizable format. Peter, have you seen this JSON format like in anything else you've ever done where you have these curly braces and then you have these property values, names and then values?
Yeah, I've seen it in, I think, is it JavaScript?
Yeah, oh, well, sure. It could exist in all kinds of different programming languages. I was just curious if you like ever seen it in like DaVinci Resolve or like in settings. Sometimes you'll have settings for an app or something like that, and it'll store the
Oh,
information.
I would see it in After Effects expressions. They're there. But I'll tell you, when the AI came out and they said, hey, everybody can code now, I jumped in. I practiced what I could.
You know a little JavaScript.
Yeah, a tiny little bit. As long as the AI tells me what to do and where to post it.
Excellent. So here we're going to head back over here to TradingView, and let's just go ahead and create. We want to tie all the events that you're seeing on the chart over here. Let me just increase the size of it. We want to tie all the events you're seeing on the chart here so that they actually trigger something for alerts. In fact,
An
we'll move
event is
down.
where that text is, close, entry, long. Those are
Exactly. So I'm just going to actually go ahead down to the 10-second chart. That way we can get a bunch of buy and sell. Hey, that might be a little too much. Let's go 15 seconds. And I'm going to go ahead and create an alert. And normally what you do in this situation is that the first one is a symbol that you're on, so the chart that I'm dealing with. Under condition, in this dropdown, I'm going to choose the name of the indicator or strategy, usually it's a strategy that we're dealing with. And you'll see over here that let's remove this for the moment. And we're going to copy and paste this default message that we're seeing over here, or a sample message that we're seeing at the back end of TradersPost. So here, what I'm expecting is that my message will allow me to pass the ticker that I'm trading, action, whether I want to buy or sell or exit my position, sentiment, that's if I'm bullish, bearish, or if I'm expecting my position to be flat, quantity, how much I want to trade, price, the current price that I'm trading at, and then this is an optional one for time, which just tells me the time now. So I'll go ahead and paste that in here into my message field. And let's go ahead and connect this message so that it sends an alert to this webhook URL. So if you'll remember at the top, you'll have this webhook URL where I can copy and then paste that within the webhook URL. So now whenever an alert is being sent from over here, it'll send this format over. So let's see what that looks like. So I'm just going to go ahead and click on create. And now if I take a look at I'm seeing these big moves, Mike, on the 5 second and 15 second, and I'm freaking out. And I'm like, hey, wait, am I missing something over here? I could lose a lot of money while I'm busy doing this video for my brother. Oh, thank you.
Just the last minute of trading here before the futures market closes, or the stock
right.
market closes at 2, and it's closed.
Perfect. Now I just have to worry about crypto, and that's it. All right. For alerts, we have that set up. We're just waiting for it to trigger some sort of an alert so you can see, Peter. All right. So over here, you're seeing here, do you see these alerts that are popping up? Maybe I could just current symbol, current interval. So these are alerts that are just popping up right now. And if I click on if I hover over it, I can see that all those placeholders that I had, all these placeholders in double curly braces, are being replaced by relevant values. So here, ticker, it's action sell, sentiment, here it's now short, one trade, and so on and so forth. So it's basically just replacing those placeholders, which are placeholders that exist within TradingView. So these are placeholders. If I go down here, there's tons of different placeholders that are available to me that I can choose from. So as that's happening, those messages are actually being sent to this webhook. So if I actually go to the logs of this webhook by clicking on logs at the top right, I'll actually see, I don't have the ticker for this because I'm trading futures. So it's saying ticker does not exist. It couldn't open a trade because I actually created this strategy for, if you remember, for stocks and not for futures. So let's just change that to futures and save it. Let's give it a second.
How many strategies can you have per subscription?
Good question. So that's you can get that on our pricing page. So when you are with a starter plan, you can have one strategy subscription created that allows you to trade one asset class, and you could connect one live broker and 4 paper brokers. Generally speaking, people will start with a starter, but it's one of those products that are just too sweet. You eventually like, okay, that was useful for one strategy. Let me go ahead and bump that up to the 5 strategy subscription one. All right, so if we head back here, we should see. Let's see here. All right, so here's some.
Just before you move on, I do know we've had this conversation before. Maybe you can remind me. Strategy subscription, you've been using them separately here, but we just saw on the pricing page it's a strategy subscription. What's the difference?
Just another way to describe this, but a subscription in general is the way you connect your broker to a strategy. So we also refer to it as a strategy subscription. If we called it strategy subscriptions on the menu on the left-hand side there, it just felt like too many words. But essentially, a subscription is a strategy subscription.
Gotcha.
Right. Because remember, it's your broker that's subscribing to the strategy. Actually, Mike, let me ask you that. So then I can create as many strategies as I want over here. The limitation is just when I get to the subscription side.
Correct.
Perfect. All right. So now we know that the process is working. That we're actually channeling signals from TradingView to my strategy over here. So through the webhook, we just saw these trades are coming through. Let me just go back to when that worked.
So you're clicking on logs there, right?
Correct. Logs, just to see all the different signals that came through. Let me just see why this is failing. Oh, my subscription doesn't have the right asset class. Let me just change that real quick. I had changed it to futures a second ago. I just didn't change it for the subscription. Let's wait for a position. I'm just looking at my broker account here just to see if one shows up. It's very different to have to do this when we're not live. I feel like I'm not on a tightrope, Mike. It's pretty interesting. I like the
Yeah,
feeling.
things slow down quite a bit in the electronic hours for futures. The games are over by 4 p.m. Eastern.
Right.
There we go.
Perfect. So my futures trades opened up. So that's the whole process right through. The signal came through my webhook. This is a signal that was received. It then, if I click on View Trade, I can see all the things that were considered for this. We won't dive into this right now. We'll take a look at that later on. But essentially, if I then go to my broker, I can see that my positions are open, and I'll be able to see all the positions that are open on my broker all together. So here it's futures, and I have stocks, even though the strategy specifically that we're dealing with is only dealing with these futures account. All right. So the reason I wanted to bring that up is that this JSON message here that we're dealing with, let me just pause this. This message, there's all kinds of different properties that have to do with that matter. So I want us to just like step through these different properties that existed within our documentation, just in case, Peter, there's any questions that pop up for that, and just to clarify the types of things that can be done. All right. So under webhooks, we'll have a bunch of our options. Now, Peter, when I'm talking to you about an asset class, what does that mean to you? Are you familiar with the different types of asset classes that can be traded?
Yeah, the different things that you can trade. Yeah, there's forex, which is currency. There's crypto, stocks, futures.
Futures, exactly. Options, that sort of thing. Just to mention, we can't do forex on TradersPost just yet, but stocks, futures, crypto, definitely, and options. And so, different. Some of some of these parameters, there's a few of them that only matter for one particular asset class or another, right? But then there's ones that matter in general. So, for example, for action, whether you're going to buy, sell, exit, cancel, or add, is true for any one of these assets. Um, you can have let's say you're long 10 shares of Tesla. You can send an order to sell 10 shares of Tesla, and that will, in a sense, close your position. But you can also send in an order to sell 15 shares of Tesla, and that will close the 10 shares that you have that are open and make you short 5 shares. Whereas under action exit, that'll just close the position that exists right now. And then cancel will cancel any orders that you might have sent in before that are pending that have not been filled. And add, under certain circumstances, will add to the position that's currently open. I wanted to jump here to order type because this is something I know when I started with trading, I just had to wrap my head a little bit around that, and that's the type of order that you can have. So when you are sending a trade, let me just switch over here. When you're sending a trade, you're sending a trade relative to the price that you want the trade to execute at. So you might be on this the S&P stock, and you might say, "Hey, I can see that I want my strategy to enter at any price. Like I'm okay with entering at any price. What's important to me is that I enter now, not that I get the best price, but that I enter right this second." And for that, you would use a market order. Okay. So a market order is, hey, broker, as soon as you get this order, as soon as you're able to go ahead and fill me, buy this position for me or sell this position for me, and I don't care what price it is, the broker will still try to get you the best price it can, but it's going to prioritize speed over your price. The opposite is true for a limit order. A limit order says, hey, I want you to go ahead and I only want you to buy or sell the stock at this specific price or better. Or better. So if I say, Tesla's trading at $100 and I want to buy it at $100, so I set in a limit price for $100, but in that time, the price moved up to 105, my order won't fill. It'll wait. The order will stay on the books at the broker and then only fill when the price comes down and to 100 or less. If it does, then I have a chance for my order to get filled.
And all the orders are GTC.
good till cancel. So we'll take a look at that in a second. But essentially, I just wanted you to get the idea here between this market order and the limit order, because this could be sometimes one of the key differences for the performance of a strategy. You can imagine that someone might have a strategy and they've tested it on limit orders where they're having these perfect entries every single time, but that when they actually run it live and they run it on a market with a market order, they're getting filled at varying different prices that eats into the profits and makes the strategy not as profitable, or maybe not profitable at all. So this happens sometimes. Some people go, well, I want it to be a market order because I don't want to miss the trade. Okay, fine. But if your performance depends on you narrowly getting in for a specific price, then you could be messing up.
Is it safe to say that the shorter your time frame is for trading, the more that matters?
Well, it depends. It's more about how long you expect your trade to be active for. So if someone is opening a trade, let's say right now, and they want to close the trade in 30 seconds, then it matters to them that they get as close to their execution price as possible, like to the limit price, a specific price when they open and close position, because they're dealing with such small differences. And so I've seen people, they'll send in orders, and their stop loss or their exit for that order is so close that it's within like the margin of the spread for the bid and ask. Like it can't even fill properly with the way that they're thinking, and they're definitely going to lose out on that trade because they're just doing it too quickly, or the price is too close to the entry price. So it's more about that. But you can be trading the 15-second chart, but if you're setting one order in now, and then you're only exiting the position an hour from now, that's fine. You can do it on the lower time frame chart. Now, aside from market order and limit order, you can have a stop order, and a stop order is sort of like a limit order, except that it says, I don't need you to fill it at this price. I need you to start filling it at this price. So, for example, my limit order for the Tesla example, let's say it's trading at 100. I send in an order, a limit price, and I send a limit price of, I set a limit price of 95. So it's trading at 100, and I want a limit price of 95 to buy. That means I'm saying, hey, broker, wait until the price dips to 95, and I'll buy if it's a limit order. And I don't want any price worse than 95. I'll take 95 or better. But if I do a stop order instead, then I'm of 95, I'm telling the broker, hey, wait until the price hits 95, then buy it at whatever price. So I really like stop orders because in a sense, I get you can get all the benefits, or some of the benefits of a limit order by waiting for a particular condition of the price to exist. But I still get into the position because as soon as it hits that price, I'm going to fill whatever. Fine, I might get filled at 105, but my strategy, for example, if the price did hit 95, that proved to be that my conditions were true, and now I can go ahead and get into the position. So a stop order sets a price at which the order will be triggered, which is super useful. And then you can have a stop limit order where both are together, where you're saying, not only do I want you to for the limit part only fill at a specific price or better, I want you to wait till a specific price has been reached. All right. So you might imagine that if I'm on this chart, let's say I'm on this chart and I'm saying that I want to go ahead and have a limit price over here that I want to buy when I get over here. For some reason, I think this is long. I'm gonna buy over here. But what I want to do is wait until I cross the price over here before I place my order. So I can say, hey, wait till this is my stop price down here. I can say, wait until I cross over here, then place a limit order. Then place my limit order, and that way I'm going to get filled somewhere around this area. So you could sort of like play around with your stop and your limits in such a way as to try to take advantage to optimize the entry you might have for it. So I might want to give myself, I'll say I want 95 to be my stop, but I'm okay with going all the way up to 98 to enter the position. That might be my limit price. So I'm mentioning all that because these are the different types of orders you can have, order types you can have, the basic order types you can have, that a strategy might rely on in order to be successful. Does that make sense so far?
It does. I do have a question. I can feel that it's a stupid question, but I have to ask it anyway.
Then don't ask it, Peter. Don't worry about it.
How is it? Okay, if I set a limit price for $100 for Tesla or whatever, then I put in an order for it to sell at 150. How am I not guaranteeing profit?
One more time.
Because there's no absolute chance that it will go up to 150. We don't know where the price is going to go before we enter a position. So you could enter at 100 and set your take profit at $150, but it may never get to 150, or it may take 2 years before it gets to 150.
But that's what I mean. So
Right.
as long as my time horizon is long enough and I don't care. So the stock market for my whole life has gone up and to the right. So
That's generally true about the whole market, right? If we combine, let's say the S&P 500, that's made up of 505 companies. The trend of all of those companies weighted together, market cap weighted, tends to go up and to the right with some drawdowns in between. But that's not necessarily true for all of the components or all of the stocks or symbols that you want to trade. Sometimes you might get into a company that might be in a sideways trend for a year, or it's been on a downward trend for a really long period of time, let's say over a year and a half. So it just depends on your approach. The buy and hold concept that I think you're referring to is generally true over longer time horizons, and the need for automation still can be prevalent, where you might get into a position if you see it cross over a certain moving average and it's been a long time, and there's been enough of a sell-off that you feel like this could be a good entry point. So you enter that position and you wait for it to hit a certain point. But maybe you don't want it to be a specified price. Maybe you want to wait for another indicator to tell you when it's time to get out. I guess your question is, am I sort of guaranteed to hit that price? And the answer is, it really depends. If you're patient enough to wait, maybe it could go up to that point. But if your time horizon for trading is much shorter, it may never hit that price target that you're hoping for.
Also, there's a path dependency. If depending on what you're trading, if you're not just straight buying the asset, maybe you're using leverage or options or something like that, something where there's another factor, you might not be able to suffer the price going down dramatically and then wait for it to go back up. You might get completely liquidated. You might lose the position because you bet that you're buying 100, sell it at 150, but for some reason, if it got to 80, you have to close out the position.
Yeah.
And so you're taking a risk that way.
I think it's a good question, though, because it begs the question of what kind of trader are you? And I think your natural instinct is to wonder, well, if the market's always going up, then why not just get in this position and hold it? Well, that would automatically start to identify you as more of a buy and hold investor type, where short-term trend trading like this, where you're in and out of positions within a day or within 2 weeks, may not be as attractive to you. And I think this is a good process to go through to identify what really interests you as a trader and investor. The vast majority of users on TradersPost in general tend to be more short-term oriented. They're interested in intraday trading. They want to be in and out of positions fast, within an hour and a half, maybe 2 hours, things like that. Sometimes they'll trade the whole session. And sometimes they want to use leverage. They want to use futures or options. So they want to be capable of using their margin effectively so they don't end up getting liquidated. For more of the long-term approach you're describing there, if I wanted to buy a futures contract in the NASDAQ 100, I can get into it today and hope that it goes up over the next year. But if it pulls back enough against me, I'll get liquidated in my account and I can't even hold it long enough to even recover from the drawdown, because the broker won't even let me hold it if it goes down too far. Then that's sort of Tom's point. Like, it may eventually get to that 150 mark, but it may also pull back to 25 before it gets to 150, which makes it more difficult for you to really profit from that position comfortably.
Right.
There's a question that well, my friend will ask me all the time, and this comes up constantly, which is so depending on the asset class that you're dealing with, there's different volatility profiles. So it could be that someone says, well, crypto goes up constantly. It goes up every 4 years. You're better than you were 4 years ago, right? In crypto. But what if there's sometimes where crypto is down 80%? So if you need your money on the year it's down 80%, well, now you're screwed. And so the
Yeah.
volatility profile of the asset makes it so that it might and theoretically be an interesting idea just to buy and hold that asset. But if you need that to capture those funds at a certain time and you're now down, you're going to realize those losses then. And so, for example, it might be useful for you to buy and hold within the S&P, right? And then have a strategy that is, a buy and hold strategy within the S&P. But on the crypto side, you do a much smaller amount of your portfolio that only buys on major dips, because that way you're capturing still that sort of like the upward trend that might happen in crypto. You're not investing money in there that you need to have that need to sell at any given point, and you're essentially getting the better entry prices that you can get, so that over time you're taking advantage of the higher return profile of crypto without suffering the downsides of the volatility, because you have the money that from your portfolio for your traditional assets that are not swinging 80% at a time in a given year.
That I get. Do you think that NVIDIA is going to be higher in 3 months than it is today?
I think Nvidia is going to zero. I don't know what to tell you. Sorry to burst your bubble, Mike. I think it's going to nothing.
Because I do understand years, and I do understand when the market turns on you, and I know there's no guarantees. But when I look at, let's say, NVIDIA, I think if I bet in 3 months, will NVIDIA still be up or higher? I'd say high likelihood. If I put in $1,000, how likely is it that I'm going to profit at the end of that? Seems to me to be very likely. So that's just money on the table, no?
I think this again goes back to the style of trading you're interested in. If you're making those types of sort of company-based bets based on your confidence in whether that company will be, higher in price in the future, that's more of a bet on the expectation that they're going to be more valuable because of the AI play, because profits will be greater, their next earnings report will be great, things like that. That's certainly a style of trading or investing, short-term investing. What I'm reminding you of is that many of the users who use this platform don't have the ability to think out 3 months, or they don't have any insight or intel or information that gives them a lot of confidence
Right.
that they know where the price is going to be in 3 months. To give you a counter argument to that, right now the average PE ratio of the S&P 500 companies is about 38, and anytime prices get this overvalued, we see big corrections in markets. So there's already signs that we're seeing volatility right now. You can make that $1,000 bet on Nvidia and still be wrong in 3 months from now, and it will go down 30%. So the question is, how far are you willing to let it go down before you tell yourself, well, maybe I was wrong on this trade.
Right.
So the struggle, of course, is deciding on your time horizon, deciding on your trading approach, deciding on your risk appetite, how long you want to be in positions for. What people tend to navigate to is these shorter term trades because they feel more confident that they can bet on where the market's going to be in 6 hours from now than in 6 months from now.
I never thought of it that way.
There's some people who live on the 15-minute chart. And to them, the trade ends at the end of the day. They're not even thinking about anything else. That's what it is. 15-minute bars at a time. I totally get that. I'm a 2-hour bar guy, in case you're asking. That's how I think about things.
Oh, is it? I feel like you're way more erratic than that.
Oh, those are the trades. I don't even talk about those trades.
Those are the throwaway lottery tickets. Is that right?
Exactly. When my wife's not around and they're all sleeping, absolutely. All right. So I wanted to walk forward testing. We were talking about before the concept of the strategy tester down here. So this is giving you an idea of the profitability of the strategy on historical bars. This is all the chart that existed already. And then we connected this to TradersPost so that we can see what it might look like, what our returns might look like as we are testing it on live data. But this is in a paper account, right? I'm getting a sense of what it might be like on a paper account. Now, this is not a fully fair example because I'm actually just using the generic TradersPost paper trading account, which is limited in some ways. Um,
Yeah,
it might
like it
be
doesn't have market data, so it appears you lost all your money on this trade when you really didn't.
exactly
We just don't know what the current price is. So you would have to connect this paper trading account to a live market provider, one of your other broker connections, in order to determine the profitability of this trade.
correct. And doing that gives me a sense of, hey, are the trades being executed in the way reliably at the broker in the way that I'm expected to see them on my TradingView chart? So is it on my TradingView chart? They're happening at it might say the trade happened at a specific price at a specific time. Um, it might happen at a specific price. Actually, if I take a look at the strategy tester list of trades, I can see it there. Okay, it entered a long position at 6,099.25. Then I can compare that to the price that I'm seeing on TradersPost to be like in my paper trading account to see, am I getting pretty much the same thing, to get an idea of what the slippage might be, right? Is it a little bit off? Is it way off? What's going on? Especially if you're using market orders. And then you can get a sense of, as you're accumulating these trades, as you run this for a little while, you get a sense of how much is my testing matching what I'm getting in the performance tester in TradingView. Then after that, you might say, okay, I'm liking the way that that it's looking. Let me go ahead and run this with real money, and then that's where you would do a subscription and tie that to.
Just before you do this, Mike, you said that we're seeing 100% loss because it's not connected to live market data.
Mm-hmm.
Are all paper accounts like that? All TradersPost paper accounts like that?
But all TradersPost ones for futures specifically. Stocks, we have market data that comes from Polygon by default, and options we're able to get from Polygon as well. Crypto market data comes for free out of the box with any of the crypto exchanges. So we get crypto data, but futures we have to pay for that data. It's not something we've done at TradersPost yet. So when you create a paper trading account on TradersPost, it tries to derive market data from wherever it can. One way you can override this limitation is in the 3 drop downs there next to your balance, Tom. If you hit Edit Broker, there's a market data source option here where if you have another futures broker installed on TradersPost, you can choose that broker and it will grab the market data from that broker instead of not knowing what the price is. So that way, when you refresh the account and you hit save, it'll actually show you what your position would be in real time.
Yeah, but I don't have record data with interactive brokers, so it's not doing that right now.
Correct. Yeah, and we don't actually support futures with IBKR either.
Right. All right. So the walk forward testing part is like just as important as making sure that you've set up your strategy correctly over here. Like after you've defined, hey, these are the rules I'm going to follow in order to enter a position. I'm going to toss on a couple of indicators on my chart. I'm going to put on an RSI indicator. I'm going to put on a moving average, what have you. And I'm going to buy whenever the RSI gets down to the overbought level, and I'm going to sell whenever it gets to the oversold level. You might be, okay, theoretically, this is a good idea. Let me go ahead and do that. Let me run the automated strategy. I'm seeing that my numbers are not as good. They're not very, very good in the strategy tester and TradingView, and they're not very good in my walk forward testing. I got to go and retool the strategy. Is there a way I can go and take a look at, hey, these are the set of winning trades that I had. These are the set of losing trades that I had. Let me see if there's anything in common that'll help me filter out false positive signals, and then so that to leave me more with winning trades. Or I might say, is there a way for me to determine where I should have more conviction so that my trades for the high conviction trades are double my normal position for a trade, and the ones that are not are less, because I want to be in the trade. I don't want to miss out on it. I just want to lose less when I'm wrong, and I'm going to gain more when I'm right. Or I might say I want to hold my position, my winning trades longer than my losing trades. Right. So my numbers might say, hey, I'm losing a lot because I'm letting it run too far. I'm allowing my position to go down, 50% in value before I even close it, right? So you might retool what you're thinking depending on the results that you get from your back testing and your forward testing.
How
Is there
long should you run your back testing for?
As long as you're capable. Unfortunately, TradingView has a pretty limited window of time in which you can run back tests for, especially in futures. I think it only goes back to about 2018 on the higher time frames, but it's an even shorter time frame if you're on like the 5-minute chart, for example. It's based on the number of bars on your visible screen that you're allowed by your plan, and that starts at roughly 5,000 bars, and then I think it goes up to like 10 or 15,000 depending on the higher price plans. But that's still a fairly limited number of bars to test your strategy. So, ideally, you want to get as much data as possible. You want to go back as far as possible to confirm that your strategy would actually work the way you expect. Like Tom here has the front contract of the ES futures, the E-mini contract, and it just started in the end of, or I guess 2022. And so the data goes so far back, but it's still pretty limited. If you were to go to like the 5-minute chart, it's not going to go all the way back to 2022. It's going to go back to like, I don't know, 2024, maybe sometime in 2024. Again, it's just based on the number of bars. The lower your time frame, the more bars it takes to cover time. So as a result, you're going to have less data available to you. In terms of forward testing, what we're really describing there is this concept of exposing your strategy to data that it's never seen before. Do you remember the last time we were talking about the overfitting problem, where you can adjust and dial in your strategy so long and so frequently, and you can optimize and optimize and optimize until you get to a point where you literally found the exact curve of the history in the past, and you found the perfect place to buy and the perfect place to sell, but that only fits in the past now. So what you've done is you've overfit those generic symbols in a way, or excuse me, those trades in a way that it just works in the past. So what walk forwarding allows you to do is expose your strategy to future data that it's never seen before, and confirm that you still have a robust strategy. But you need to run it. If let's say you're running a strategy that works on the 5-minute time chart, you need to run that for a couple of weeks to get enough trades to come in to confirm that things are looking good.
Wow.
If you're on the higher time frames, let's say you're on a 4-hour chart or the daily chart, it might take you a few months before you have enough trades that have come in before you feel pretty comfortable with the performance. And this is, again, I think, why so many people are incentivized to trade on shorter time frames, because it allows them to test things in a much tighter time frame and then expose themselves to live capital at that point. Because it feels like lots of times people don't have time to wait for data to come in to validate their results. So the walk forward process is really just this process of confirming that all the trades are going to come through the way you expect. In addition to making sure your strategy is robust, it's also verifying that the trade's going to get executed with the broker the way you expect. The take profit's going to get hit the way you expect. The stop loss is going to trigger the way you expect, or the backup exit signal is going to trigger the way you expect. So we always encourage people to use TradersPost for their walk forward testing, because it's a good way to verify that your entire strategy and the round trip of a trade is going to be executed exactly the way you expect.
So I found, Mike, let me know what you think about this. Whenever I test my strategies out, or even when I develop them, I never develop them on real time, like the most up to date current data. I always do it on 2 time frames. One is a relatively low volatile period, sometime in a year ago,
Mhm.
and then I'll measure it. I'll run it on where there are high, like black swan events.
Sure.
before and after that event as well. And only after those numbers look good do I then now run it on the most recent 6 months to a year.
Mhm.
And that gives me enough confidence to go ahead and move forward. Is that a way of simulating the
A
walk
walk forward
forward
test.
without having to wait for the bars?
It's certainly another way to do it is to split up your data in ways that for sure when you were testing the strategy originally, you were using virgin data that you've never tested before. That now becomes what we'll call your in sample data, right? Or your back test data. The walk forward should be the final step of this where you've exposed the settings that you've dialed in to this new testing window. And the rule behind this is that once you're in the walk forward period, you can't keep optimizing on the strategy. All you're doing again is raising the potential that you've just recreated an overfit environment. So
Right.
if it doesn't pass muster in the walk forward window, then it's still not a robust strategy. It's time to move on to something else.
Well, now I know why you guys keep reminding people to do paper trading, because I my guess is that a lot of people are just like, I'm not waiting weeks to put on my trade.
That's
Like
right.
this is an impulse environment, and
Especially
honestly,
when you
I'm
do it
shocked that you have
and you see, like, had I put this on right now,
right.
I would have made this money
Exactly. Tom, you have that conversation with me all the time. You're like, oh my
constantly.
God, look at it. I go, wait, hang on. Did you know this information before? You beat yourself up. So I guess part of the benefit here to automated trading with Traders Posts is that it kind of encourages you to do the homework. It's
Mhm.
almost kind of gamified because you get the numbers, you get to see what's going on,
Mhm.
and it helps you to keep you on the straight and narrow when it comes to trading. Better than just wild west and just go out there and just do stuff without paying attention.
Sure. I think in general, it's also a way to stay more consistent with your risk approach, right? Many of these trading strategies are sort of built in with this concept of risk reward and your win rate. These are the two things that create what we call expectancy. So how often do I win? Hopefully more than 50% of the time. And when I win, is it more than I lost? What is the ratio between the size of my wins versus the size of my losses? So many times we're looking for strategies that are at least 50 or 60% profitable, but have a profit factor of two or 3 to 1, meaning that I'll make $3 for every $1 that I risk. And as long as I'm consistent in that approach and my strategy is robust, and it seems to be consistent even in the walk forward period, it's just a matter of letting the strategy play out now. Every time it takes a trade, it's taking it the way that I expect. It's keeping my risk tight. So the possibility of getting to that point where I've seen a return from it increases over time. The main problem that I think you'll run into often comes down to not letting the strategy run long enough in order to see the benefits of that of that long-term performance. In general, like when we look at a back test, there should be at least 100 trades in there for us to feel pretty confident that we have tested a period of time that gave us enough trades to verify that there are good results there. And then the walk forward period, we want to see roughly the same number of trades, if not more. But when we're ready to put live capital in front of it, you could be 5 trades in and all 5 were losers. And you might think to yourself, oh, it's not a great strategy. But in reality, you need to wait long enough for the statistics to play out. Does that make sense?
Totally. Wow.
You'll see here on the screen here, Peter, just an example of something I know did. So they set up they didn't want to only rely on the strategy tester for the performance metrics. They wanted to calculate themselves. They factor everything in terms of RR, so risk reward ratios. They want to know what's their losing streak, what's their winning streak, because they need to know for them, depending on the prompt firm that they were dealing with, if they lost this many times in a row, then they would blow out their account. So they knew it didn't matter how good the win rate was if the losing streak was too high. Um, uh, Similarly, if the commissions that are actually being calculated, I'm surprised by how many times people don't actually calculate the commissions that they're actually are charging. That ate into the returns, and so there's all kinds of ways you can techniques that people use in order to actually get better insights as to the viability of their strategy.
Right.
How did you pull up this menu, this stat menu?
I just built it, so
You built it
I just
inside the strategy. It's not a feature of
exactly.
TradingView.
Oh my goodness.
Yeah.
You're showing me the good stuff, Tom.
Well, look, some of us have BMWs, other people they walk. What do you want me to do?
Well, for what it's worth, we of course are making improvements along this line to TradersPost. We have a whole analytics package we're working on, which is going to include things like the win rate and the profit factor, your winning days versus losing days, a calendar of your performance over time. So ideally, you'll get to a point where you just start sending these alerts to TradersPost. We're monitoring your trades as they come in, and you can just keep track of the performance right there on our dashboard. So whether or not the strategy you're using has Tom's fancy, super cool dashboard built into it, you'll get these types of analytics very quickly here at TradersPost.
You guys even see the good one. I even showed the good one on the screen. All right, just want something that Peter can understand. All right, so I think we'll leave it there for this episode. The next one I really want us to touch on. We're going to get you put live money into an account, Peter. We're going to go ahead and trade live things. I want you to see the one. I want your heart to be just completely beating and your pupils to be dilated.
It
Just
won't.
watching what's going
Wait,
on.
whose money are we risking here? Are we risking Peter's money or your money, Tom?
No, his money. It's brotherly prerogative. How can make him risk his own money?
It's not a real lesson if it's not your money, right?
Exactly. And I'm going to go through the nuances of the alert and the alert logs. We're actually going to send this so it passes through to a live account. We'll do a crypto account for you, a live account. And then just to see, okay, we're going to actually walk you through. This is how we actually build the messages that we need. We'll use like an off-the-shelf strategy. Hey, maybe even use Luxalgo. It might be fun to try that out. An off-the-shelf strategy, and just to run it with real, so that you can see some of the things you have to consider when you're dealing with alerts. It can be a sticking point for some people. There's no way around this, no matter what service that you use. You have to wrap your head around that. There's this communication that happens from TradingView to your broker. So we saw that as an overview today, but we're going to go into detail next time as you run it with live money, if that's okay with everyone.
Sounds good.
What is the easiest, or is there an easier asset to start with if you're a beginner? You chose futures here, but we saw that there was a wrinkle because of the live market data.
Mm-hmm.
Is it better to start with stocks or?
I like crypto because you can have very small sizes if you want to. And when you're trading Bitcoin, there's no real slippage when I'm dealing with Bitcoin. Nothing that really matters.
Mm-hmm.
And you're not in the situation when you're like, can I buy a whole share of Tesla? Can I not? Like, you're not dealing with any of those fractional things. So I do like that. But Mike, do you have a different opinion about what might be easier?
No, I like it for that reason too. Crypto is one of those areas where you can make as little as $5 bets each time. And so you're risking maybe a few pennies on every trade. So it's a really good environment to just, sort of get your feet wet with and not put a whole lot of money at risk, but still get to see the effect of this trade compounding into a return. So if you're thinking in percentage terms, you could take $5 and turn it into $7. That's a pretty good return if you're thinking about it in orders of magnitude greater than that. Now it's a $50,000 account. Turning it to 70 sounds pretty attractive if our approach is worthwhile. So yeah, I think crypto could work. It's definitely an area where we can test out, Coinbase or Kraken or one of our crypto integrations and test that out. The other obvious advantage with crypto is that it's open 24/7, so we don't have any timing issues to worry about. We can just let the strategy run all day long and all night long. It's what attracted to me to automated trading in the first place way back in 2017 was, well, shoot, this market's open all the time. I don't have to worry about maintenance windows or anything like that. Just run it. Just let it run all day long and all night long. And I'll wake up in the morning and see how I did. Many mornings it was not so good though.
I have one more question. Does the size of your position ever matter? Like, let's say you have a strategy and you put $100 in. If you put $100,000 in, would the outcome be the exact same proportionately, or because you have to have buyers and sellers? And
there are two ways that it could matter. One is when you're just talking about manual trading, or not even just manual trading, any trading, if the size of the position makes you sweat, makes you nervous, your size is too big. I learned that lesson the hard way. Reduce, because you think to yourself, well, I'm not going to make as much money. Yeah, you're not going to make as much money, but you definitely won't lose as much money.
Right.
Shrink that position until you can almost forget about it, that you feel totally comfortable with it. You won't make these rash decisions. But the other side is the liquidity of the asset. So liquidity in this sense means what is the likelihood that I can buy or sell this asset without it drastically moving the price?
Right.
By what amount it'll move the price? And so if the order size that you're putting in would drastically move the price, and you're trying to buy a lot of it, let's say, well, then you're going to get terrible prices when you get filled, because the order book, you're not buying it from nowhere. Someone has to sell you. There has to be orders on there to sell that asset to you.
Mm-hmm.
Sometimes you might not even get filled if there's not enough on the order book. You can't even get filled for the volume that you're trading. In the crypto space, you'll find this for some meme coin that some teenager lost from his backyard is $10,000 worth of liquidity. If you're trying to buy $20,000 worth, you're going to be moving this price drastically. But on Bitcoin, you're not going to be moving it at a million.
Yeah, that's what Tom was saying earlier. We can test this out on Bitcoin because it's one of the most liquid traded assets on all of the crypto exchanges, as well as Ethereum. Those two tend to be the most traded assets on these platforms. But if we choose like Pepe coin or something like that, there may be some slight slippage. There's a lot more of a liquidity issue in crypto than there is in things like futures or in the stock market. However, there's tails everywhere, right? So like there's definitely stock tickers that have just as little liquidity as crypto does, that if you tried to trade this little tiny OTC penny stock, you're likely going to move the price.
Right.
But if you wanted to trade $150,000 worth of Microsoft, you're not going to move the price at all.
I always loved feeling like a big shot sitting on some junior miner, moving the ticker, be like, oh, that's my candle. I move that candle. I change the chart. I feel like Jim Cramer here.
I've definitely seen that, especially in crypto. Moving like $20,000 positions is enough to move the price quite a bit. So, limit orders are where it's at in crypto.
Right. All right, Peter, we'll leave it there. I'm going to thank everyone for watching, and I'll send you, Peter, my affiliate link, because there's no reason for me not to make money off of you losing your money. So stay tuned for that. And next week, we'll talk about alerts, the nuances, and logs. Should be pretty interesting.
And just finally automating something, getting something up and running.